A whole life insurance policy can look like a guaranteed financial asset until one misunderstood word quietly changes what you thought you were buying. Whole life sounds simple: lifelong protection, fixed premiums, and cash value. But those three ideas contain almost everything people misunderstand. The key is separating what the contract guarantees from what an illustration merely projects. Whole life is permanent insurance designed to remain active for your entire lifetime, as long as the required premiums are paid. The policy normally combines three core pieces: a premium schedule, a death benefit, and an internal cash value account. Your premium is the amount required to keep the policy in force. In traditional whole life, that scheduled amount is usually level. But level does not always mean you pay for life. A 10-pay or 20-pay policy collects higher premiums for a shorter period and then becomes paid up. Payment frequency matters too. Monthly billing may cost more over a year than paying annually because of modal charges. And if you miss a payment, the grace period gives you a limited window to catch up before coverage is at risk. Now comes the feature that attracts the most attention: cash value. It is an internal policy value that can grow over time. It is not a separate savings account, and it usually grows slowly at first because early policy costs absorb part of the premium. Guaranteed cash value is the minimum promised in the contract. Non-guaranteed values depend on dividends or other assumptions that can change. And cash value is not always the same as surrender value. Surrender value is what you may actually receive after charges and adjustments if you cancel. The death benefit is the policy's central promise, the amount paid to your beneficiaries when you die while the policy remains in force. A primary beneficiary receives the benefit first. A contingent beneficiary is the backup if the primary person cannot receive it. An irrevocable beneficiary is different because changing that designation usually requires the beneficiary's consent. Some policies maintain a level death benefit. Others may increase over time when dividends purchase paid-up additions. You may also borrow against the cash value, but a policy loan is not free money. It accrues interest. Any unpaid loan and interest can reduce the death benefit. If the balance becomes too large, the policy may even lapse. Some mutual insurers may pay dividends, but dividends are never guaranteed, even when a company has paid them for many years. If paid, dividends may be taken as cash, used to reduce premiums, left to accumulate, or used to buy paid-up additions. Riders can add useful protection, such as waiver of premium or accelerated death benefits, but each rider can add cost and complexity. Cash value usually grows tax-deferred, but surrendering a policy for a gain or allowing one with a large loan to lapse can create tax consequences. When you are ready to compare whole life options clearly, Quote Maestro can help you review multiple policies side by side without getting lost in the terminology.